All right, let's get going here. Well, I'm so glad that you're here. What we're going to talk about today is exactly what's going to be happening for the rest of the year in the stock market. And I'm going to tell you how I'm going to play it. I'm going to give you a scenario of what I think is going to happen. And I'm even going to tell you how I'm going to be playing the stock market so that you can make some money as well. If you have any questions at all, be sure to put them in the question box. I'll try to answer them all if I can. And with that, let's get going. Now, some of you may not know who I am. So let me just briefly introduce myself for you in case you don't know who I am. I manage the #1 mutual fund in the United States. I managed the #1 macro hedge fund in the world. I managed the #1 stock picking newsletter, which I still write to this day. I've written 10 books on trading. Here's 2 recent ones. I've been on the cover of magazines, and Timer's Digest ranked me as the #1 gold and bond market timer for years and years. I've been on TV over 1,000 times. I'm the most sought after investment trainer in the world. There I am in front of 2,500 people. And here I am. This is things kind of go crazy at my events. What can I say? So kind of cool, kind of cool. I like it. What can I say? All right. But the first main thing is that I really trade. Every single day of my life, I trade, except on Saturday and Sunday when the markets globally are closed. So I'm putting into effect all the things that I'm showing you are what I actually do every day. I'm not one of those guys who pretends to be an expert. I am an expert. But really, the most important thing is I help people learn how to be financially free. So I take the expertise that I've learned in 50 years of trading and I pass it on to my students, my subscribers to my newsletter, and so on and so forth. And that's my mission in life right now. I'm financially free, but I'm trying to help people learn how to be financially free. So with that, let's get right into it. Here's our agenda. I'm going to talk about the current situation in the stock market, but of course, we're going to talk about the monetary situation, the economic situation, the seasonal situation, historical, analogous, technical. I'm going to then tell you exactly what's going to happen. And finally, I'm going to tell you my trade plan of how I'm going to be making money from this. What you're going to see in this presentation are many unique ways of analyzing the markets, ways that you've never seen before. Now, why do I use unique indicators? Because if I use the same indicators as everybody else, I get the same results as everybody else, which means poor results. My job as a professional trader is to make money every year, which means I have to look at the market in a way that's different from everybody else. So I go through a very rigorous path of how I analyze the markets, and I'm going to show you that path tonight so you can see. The reason I'm going to show it to you is, first of all, I think you're going to find it interesting. I think you're going to find it educational. But most importantly, I want you to test me. I want you to look at this and say, this guy's completely full of it, or hey, that's a pretty good idea. I want you to understand my reasoning, not just accept it. All right, what's the current situation? Oh, wait a minute, I have questions already. Holy smokes. Wait a second. Oh, I'm gonna answer all this. This is great. If you don't hear any sound, the problem is on your answer. It's on your end, okay? All right, let's get going. Current situation. So we now have the loosest monetary policy in the United States since the Civil War, and that was in the 1860s. So we're talking about 150 years ago, we have the loosest monetary situation in 150 years. This is astounding. We have the loosest fiscal policy in the United States in history. There's never been one ever looser at all. This is real. These are astounding things to say. We have the loosest monetary policy in developed countries ever. So by developed, I'm talking about Europe, I'm talking about Japan, et cetera, et cetera. There's been some undeveloped or emerging markets that have had looser monetary policies. Argentina, oh, that's right, they defaulted. Greece, they defaulted. Oh, Italy, they defaulted. Those are developed countries there, they defaulted. In other words, we have a disastrous monetary policy in the United States right now. We have the loosest fiscal policy in developed countries ever. Yes, we've seen this policy in some third world or emerging market countries before, but never in a major developed country. This is the loosest fiscal policy ever. We have anti-business policies from the Biden administration. They're coming. They're not here yet, and I'll talk about them more in detail later because there are some nuances that are not being reported in the news. So we'll go over those. We have higher taxes coming in the United States. Once again, I'm going to talk more about that later because there's some things that they're not telling you, and I'm going to reveal to you. And we have the biggest intrusion of the federal government since the Civil War in the 1860s, and that is coming true. But once again, we'll talk about that more later. All right, so let's start with money. Why money? Because money drives stock markets. If there's money being pushed out there by the Fed, by the central bank, guess what? It shows up in the stock market. And you can see that the monetary explosion that we're seeing right now of trillions of dollars is skyrocketing, even more than we saw in the 2008 recession. We're pumping more money into the system than we ever have been. How do I rate that? That's bullish. Money, when it goes into the system, it helps out the banks first, and it helps out the brokerage accounts and the stock market second. It helps the people out maybe later. So this is monetary base is what I'm looking at here. And monetary base is a form of money that's basically 100% controlled by the Federal Reserve Bank. So we can see that clearly they want easy money. Now, the problem is this. You see, there's money supply, but this is what most people don't tell you. The question is the money turning over in the economy? In other words, if I hire someone and I pay them money, then that person goes and pays their rent, and then the landlord goes into a restaurant. That's called the velocity of money. So the money that that the Fed puts into the system, how many times does it turn over? So if it turns over 5 times, that's a lot. What if it turns over 3 times? That's a lot. But look at how the velocity of money has been declining since the 1990s, and so far this year it has collapsed. In other words, people aren't spending the money. The money is being pumped out by the Fed at an astronomical rate, but people are just hanging on to it. The savings rate in the United States is the highest it's been since World War II. They're holding on to the money. Now they're holding on to the money because they're still fearful of the future. They don't know if they're going to have a job. They don't know if COVID's going to end. There's many reasons for them hanging on to the money, but the Fed's pumping, and it's not having the effect that they want it to. But notice in the lower right-hand side of this chart that it is stabilized. It's not plunging anymore. So if the Fed keeps pumping money and the velocity stabilizes, that's going to really help out the stock market a lot. The point, though, inflation is coming back bigly. You see, if the money supply is going astronomically higher and velocity is stable, then that has to mean higher inflation, and that's going to affect every market there is. But initially, it really helps the stock market because generally speaking, in the early stages of inflation, which we're in right now, companies can raise their prices faster than their costs raise, so their profit margins go up. And we're in that phase right now. Now, down the road, what happens is that the costs of the company, their labor and their hard material costs, go up faster than the prices do, and their margins decline, and that's bearish for the stock market. But that's not going to happen this year. Right now, inflation is going to be positive for the stock market because it's going to allow companies to have higher profit margins. Now, fiscal policy. What's the federal government in the United States doing? Well, as you can see, this shows the deficit or budget surplus of the federal government going back a few decades. And you can see early, let's go back to the 2008 recession. We went into a deficit and then we slowly kind of raised up. But notice early in COVID, we saw a tremendous plunge. And the government, the federal government and the Trump administration went out and spent money, trillions of dollars, in order to try to support the economy. Now, then that all went away, but now the Biden administration is now putting even more money. Even though the COVID crisis is near an end, they're pumping out money like crazy, and they're trying to get Congress to agree to $6 trillion more dollars of spending. Now, let me stop right here. I mentioned before nuances. The way it works in the United States is the administration with President Biden proposes a budget. The reality is the budget never passes. Okay, we haven't passed a president's budget probably for 60 years. But it gives an idea of what the president wants to see. Well, he's not going to get $6 trillion. He's not going to get 5. He's not going to get 4. But he might get $1 trillion more. He's going to want higher taxes on corporations, on individuals, on capital gains. And we'll talk more about that later. I don't think he's going to get those either. He's going to get some tax hikes, but not as much as what he wants. So the point of it, though, is that fiscal policy is going to remain very loose. This line is plunging, and it's going to probably break the low that we saw in 2020 under the Trump administration. Here shows the total public debt. So back in 2008, you saw that the public debt took a hike up, started to go up and really accelerated. It kind of slowed, and now it's skyrocketing again, and we're up to $28 trillion as we speak today. Now, the problem is that that people can borrow money for good reasons or bad reasons, and let me try to break it down. If I borrow money for consumption, so I want to buy a new car, I want to buy a refrigerator, if I borrow money for that, that's not really that good because I'm going to have to work extra hard to pay back that money and pay back the interest. If, on the other hand, I borrow money so I can invest, so I want to grow my business, I want to build a new factory, I want to buy computers to help my staff work better, that could be good or bad. Generally, it's good. Generally, investment, borrowing money for investment, creates opportunity and creates wealth in a society. But borrowing money for consumption means you're destroying wealth. So when the federal government borrows money, any federal government, US or any federal government, when they borrow money for consumption, that's usually pretty bad because they have to pay it back, which means that somebody, i.e. the people of the United States, have to work harder to pay back that money, which means that their money goes to pay back principal and interest rather than having a good life, or rather than investing and making their life better. So what can happen is that when the federal government borrows money, it can boost the economy short term, but it declines the economy long term because it has to be paid back. Nothing's free. So there's no free sugar high in the economy. They have to pay it back. So this is short-term bullish, long-term bearish. Okay, to put it in another perspective, this line shows the federal debt as a percent of gross domestic product. And you can see for years, the United States had very low debt. But in 2008, it took a big jump up. And this red line is 100% of GDP. Now you can see we've skyrocketed up to, we got almost up to 140%. Let's call it 130 right now. Now, this is a critical area. In most countries, not the United States, I'll come back to this in a second. In most countries, when debt gets above 100%, that usually means that the economy starts to falter and fail. So, for example, Japan has been in a recession for 30 years. What's their ratio? It's the world record, 220%. They have so much debt in Japan that literally 2 generations of people are paying it off. And there's no economic growth in Japan. Now, fortunately, they created a lot of wealth before they went into the recession, so they live pretty nicely. But many third world countries get into this problem and they become basket cases. Venezuela was the wealthiest country in the Western Hemisphere at one time. Argentina was the wealthiest country in the world 100 years ago, and then they got caught into this debt trap. Now, when you see European countries like Greece or Italy get into this problem, they go into recessions, and they always do. Now, the United States is a special case because it's the reserve currency of the world. So it can probably have a higher debt than most countries. We don't know how high it can get because, generally speaking, we've only had a few reserve currencies in the history of the world. Spain, England, maybe Holland for a short while, and the United States for about 100 years, 90 years, let's say. So we don't have a lot of experience to know exactly what happens, but we do know that a reserve currency can go into debt more than a non-reserve currency. So maybe we can go to 130%, maybe we can go to 150% without problems occurring. But the way that the government is spending money, we could easily be at 140% day after tomorrow. We could be at 150% by July. So the acceleration in the debt is very disturbing. And it's disturbing the world and putting pressure on the US dollar. Okay, now, one of my most favorite topics, taxes. Right now, President Biden is proposing higher income taxes. Now, he's saying it's only on people who earn over $400,000, but that's not true at all. I'll get to that in just one second. But whenever there's a basic rule of economics. If you raise taxes on something, you get less of it. When you lower taxes on something, you get more of it. So if you raise taxes on income, you have less income in society. So why is that a good thing? It can't be a good thing. We want everybody in society to make more money all the time. So is this going to pass? I think some form of higher income taxes will pass. Higher corporate taxes. See, this is where there starts to be some falsehoods here. Who pays corporate taxes? I'll tell you who pays it, not corporations. They just raise their prices, and so two people pay for the higher corporate taxes. First of all, consumers. You pay more because the corporation they raise the price of something from $1 to $1.05, and you pay for it. They just pass it through to the government. So higher corporate taxes are a raise in taxes on all consumers in society. But the other people that pay are the workers, because if the taxes have to be paid, that's less money that the corporations have to pay their staff. So the people who pay higher corporate taxes are not corporations, it's the workers and the consumers. This is a killer. I don't think this one's going to get passed, but there might be an increase in capital gains taxes. Now, if you raise taxes on capital gains, then you get less capital gains in society. So what happens is that capital has a value and there's a return to that capital. Let's say a stock has a return on their equity or on their capital of 10%. I'm just making these numbers up. If capital gains double, which is what Joe Biden is proposing, then the price of the capital itself has to drop in half in order to maintain the 10%. In other words, stock prices will have to drop by 50% in order for investors to remain receiving 10% return. So a raise in capital gains taxes would cause a bear market in US stocks, pure and simple. Now, once again, I don't think he's going to be able to double taxes, but will he raise them? I think he will. And depending on the other policies, that'll either cause a correction or a bear market. If the other policies are positive, then maybe it'll only cause maybe a 5 or 10% correction. But we have to really watch for raising capital gains taxes. Now, another thing that's going on is that the government's policies are choking off supply. So what do I mean by that? Well, he's paying people to be unemployed. Right now, people can earn more money being unemployed than getting a job. So of course, I'm going to just take a nice vacation, and when my unemployment benefits run out, then I'll go get a job. But what that means is we now have a shortage of staff. We have more jobs available in the United States than people to fill them because people prefer to be unemployed. They get paid more. So restaurants, the economy would rebound much quicker if there was no unemployment benefits, because people will go get jobs in the service industries, restaurants, tourism, et cetera, et cetera. Those businesses are crying for staff and they can't fill it. So the economy's not growing as fast as it could. Another way, Joe Biden did an executive order to stop all fracking and drilling on federal land. Now, you got to realize that federal land is land owned by the federal government is a huge amount of land, particularly in the western states. I have an office in Las Vegas, and in Nevada, something like 90%, over 90% of the land in Nevada is owned by the federal government. But for example, eastern New Mexico is a big oil producing area. Not anymore, all gone. Alaska, no more. Texas is still mainly privately owned, so there'll still be drilling and oil production in the state of Texas, but many other places that's not going to be the case, okay? So what's happening then is that means we have higher energy prices. Gasoline in the United States is now 50% higher than it was in January because of these policies. So that's inflation. When you pay people to be unemployed, that means that companies have to pay more for their labor. That's called inflation. So choking off supply is not helping the economy. Greater regulations, we're just starting to see those. That also chokes off supply, causes inflation. $15 minimum wage. They won't get that through Congress, but the president has already made it so that all people who work for the federal government or who supply the federal government have to have a $15 minimum wage. So what that means is only big companies will supply the federal government. Small companies can't afford $15, so they're not going to supply anymore. So there'll be more unemployment because of this rule. And it also means, of course, inflation. It means more federal government borrowing, etc. Once again, choking off supply, causing inflation. Okay, I want to shift gears entirely. We've talked about economics till I'm blue in the face. Now what I want to do is shift to a completely unique form of analysis that you've never seen before, probably never seen before. And this form of analysis is called historical analogous. Historical analogous. Write that down. So this chart comes from a company that makes these charts called MRCI.com. MRCI.com. Excellent company. Love their work. And what they've done is on this, you'll see a number of lines. And let's look at the top panel first. The top panel shows a chart of the S&P so far. I mean, this chart's like a week old, but and you can see the chart going up and down. Then you'll see there's a green line superimposed on the existing and going out into the end of the year. Well, what is that green line? The green line is actually what MRCI did was they went back and they found all the years in history that had a similar price performance, and they melded them all together and came up with that green line. So in other words, they're saying, well, all the years in the past when they acted like this is how they continue to act. And as you can see, the market kind of continues to rally up until early part of July, and then it kind of goes sideways. Okay, kind of goes sideways. Now, seasonally, the market usually goes sideways through the summer. So we now have a scenario of what should happen over the next several months. Nothing, not a lot of anything. More volatility because of all the monetary stimulus, but not a lot of net gain or net loss. And that should carry through until at least August. Now, let's take a look at sentiment. This is really quite fascinating. You see, when you do sentiment analysis, what you're looking to do is you're trying to look for extremes. Let me give an example. If let's say 100% of people were bullish on the stock market, what would the price of the stock market do? Stunningly, it would go down. If everybody was bullish, the price of the stock market would go down. Well, why is that? It's because there's nobody left to buy. If everybody's bullish, they've already bought, so there's nobody left to buy. So what you don't want is you don't want extremes. You don't want a situation where everybody's bullish or everybody's bearish. Now, this chart up at the top part of the chart shows the last 4 weeks. And you can see that the green part, this is how many people were bullish, gray is neutral, and red is bearish. Well, all of a sudden, last week, we saw a big increase. 8% more people got bullish, and you can see about 7% of people got less bearish. Now, the 1-year bullish high over the last year, the most bullish we've seen is only 57%. So this is not an extreme number. I find this to be a bit bullish because it means there's still lots of room to go on the upside before we get to the point where people are too bullish. So count this as moderately bullish. Okay, now let's shift over and look at some technical analysis, because now we need to start building our scenario of what's going to happen. We've looked at the fundamentals from the monetary and fiscal. They're very bullish right now, very bullish now. Bearish in the future. That's why I call this this webinar boom bust. We're in the boom phase. We're in the boom phase. There'll be a bust, but that'll be next year, not this year. We're in the boom phase right now. So let's take a look at the weekly chart. Each one of these candles is 1 week. So this chart goes back several years. Now, one of the things that's happening here, you can see it's a clear bull market. It's a fantastic bull market since the COVID bottom last March. But look at this little diagonal red line right here. And you can see it's on an indicator here called stochastic. And the stochastic indicator is really an indicator of momentum. And so what this says is the momentum of the market is declining. It had been very bullish, but now look at this. We've really gone nowhere for a couple of months. We're just kind of rotating around. We're doing nothing. We're churning. We haven't made a new high in the S&P for weeks. And the NASDAQ is a long way away from its highs. The Dow's doing pretty good, but the S&P, not so hot. And the NASDAQ really kind of crappy. So the weekly chart, bullish, but there are warning signs here. Let's take a look over here at the daily chart. Now this one starts to get interesting. So this right here, I've got the horizontal green line and a diagonal green line. In classical charting, that's called an ascending triangle. Now, a lot of people talk about classical charting and chart patterns, and you know what? 90% of them do it wrong. One of the critical things that they forget is that there has to be a confirming volume activity. And the rules as stated by McGee Edwards, who really codified this back in 1948, they said an ascending triangle formation is a consolidation, and it's a bullish consolidation. And we should see the market break through this horizontal line on the S&P. That's great, but it's not a legitimate ascending triangle unless, now let's look down at the bottom of the chart, we see declining volume. And look at that. We see declining volume as the market goes through the pattern. So this looks like a legitimate ascending triangle formation, which should pop to the upside and give us a nice rally. Okay, so looks pretty good from a technical perspective. Okay, so let's talk about what the scenario is. We've gone through the various factors. Now we have to kind of put them all together because some of them are bullish and some of them are bearish, but we have to trade. We have to make money. So I think that right now we're going to see the boom period, the very top thing here. The economy will boom into at least the fall. Let's say August or September. We should see the stock market do well. We should see the economy do well. But then we're going to start to see the economy grow slower. We're going to see some of those policy decisions of high debt, high regulations, higher taxes, all of those things start to bite. And we're going to start to see slowing of the economy. We're not going to see 6% growth or 3%. We might start to see 2%. And even the Biden administration is saying that in 2022, we won't grow past 2%. That's what the Biden administration is saying. Then we're going to move to higher inflation. And by the end of the year, it's a no-brainer that we're going to have inflation at 5%. I think it might be higher than that. I'm really being conservative when I say 5%. I could say something super dramatic, but let's just say over 5%, and we're at 4.2% right now. So saying 5%, that's kind of a no-brainer. 6, 7, 8, 9, even 10% are possibilities. So the stock market will rally into the late summer or early fall. And I think then that when the economy starts to slow, we'll see a 10% correction. And that will be in August, September, October, in that time frame. Now, that is in a way a good thing. Here's why. It'll scare everybody to death. Everybody will think that it's the end of the world, the apocalypse is upon us, and the stock market's going to drop dramatically. And instead, it'll only drop 5 to 10%. It'll shake out all the weak hands that are in the market, the overly bullish people. And then we'll start to rally more as inflation comes back and real interest rates decline. Now, let me explain this. You see, one of the most bullish things that can happen to a market, and I'm going to talk about gold next week, I think, but here's the point. But one of the most important things that is bullish for the stock market is real interest rates. Real interest rates are if you take interest rates and subtract inflation. So right now, we have negative real interest rates. That is to say, you can borrow money for free. Well, guess what? People are borrowing money for free and they're buying stocks. So we're seeing this incredible boom in the stock market, largely on the back of borrowed money. Why? Because it's free money. Inflation is higher than the interest rate. So we'll start to see that come back. And at the same time, all of this is happening, we're going to see a big boom in the commodities market. And we're already seeing that. And of course, that's causing more inflation. So commodities, stocks, all going to be boom. We've got to have that shakeout first, I think, in August, September, October. We'll get that shakeout, and then we'll boom again going into the first quarter of next year. Well, then what happens? Well, then I think we've got phase two of our scenario. And this really starts to kick in now, but it really accelerates next year. Risk is dramatically increasing right now. And it's going to continue as central banks keep interest rates at zero or below zero in some European countries. That's increasing risk. Now, look around the world. We have a housing boom around the world. We have Bitcoin going to crazy things. We have meme stocks going to crazy levels. We have the biggest bubble in bonds in global history, in human history. So risk is increasing dramatically right now. And it's going to continue to increase. Why? Because of central bank policies of keeping interest rates so low, they're below where they naturally would be. So sometime next year, the Fed is going to start to tighten. They're going to say, oh my God, inflation is now 5 or 10%. We said we wanted it to be over 2% for a while. The European Central Bank says, oh, we want it to be over 2% for a while. Japan's been trying to get it over 2% for 30 years. But eventually the Fed, the ECB will start to tighten because there's no way they can say that the economy is being affected by COVID anymore. Now that tightening is going to cause a wave of bankruptcies. Right now, we have record-setting number of zombie companies. Zombie companies are companies that they're not bankrupt, but they can't pay the interest and principal on their debt. So they are the living dead, okay? They're the living dead. Higher interest rates will cause those companies to go bankrupt. We already have a corporate debt at record-setting rates in the United States. We have government debt at record-setting rates. Personal debt is actually in pretty good shape, but it's starting to move in the wrong direction. It's starting to increase. So it's not at a bad level yet, but maybe by next year it will be. And so I'm afraid then we get the Biden bust, which is we could see a major economic crash in 2022, a stock market crash in late 22. That would then cause gold to drop. I'm bullish on gold right now. We would see gold drop when this crash comes, but it would rally later. The reason it goes down at the beginning of stock market crashes is people sell off other assets in order to support their stocks. So Bitcoin would go down, gold would go down, and then commodities go down as we go into a recession. So I've now explained to you the boom, that's this year really, and then the bust is really kind of come next year. So we can make a lot of money in the boom and the bust. Now, you need to be on top of the situation because obviously negative things late next year could impact your job, your house, your business, and so on and so forth. So you need to protect yourself from all of those things. But that's a year from now. We need to stay focused right now on making money in the boom period and then preparing for the next big move, which will be down in a year from now. Okay, so what's my trade plan? How am I going to make money for this? Right now, I'm long stocks, I'm long ETFs. I like being long stocks and ETFs through the summer, even though the summer is not going to be super bullish, but I think I can pick stocks that are really good. I showed you that I had the #1 mutual fund and hedge fund because I think I'm pretty good at picking stocks and ETFs. So we're going to make some good money in the stock market through the summer. We'll start to take profits in August because I think we're going to see this dip in August, September, October. Let's say 5 to 10%, something like that. But that dip is going to be a big opportunity in that late summer, early fall. And we're going to then see a nice big bull market take us into the first quarter, second quarter of 2022. And so we'll make another big leg of profits going forward until the Biden bust comes, I think probably late in 2022. All these things take long to occur. So this is my trade plan. This is how I'm making money right now and how I expect to make money over the next year. So how can I help you? Well, one thing I can do is I put out a publication called Wall Street Winners. We started it in 1995, and as I showed you, the Holbert Financial Digest recognized it as the most profitable stock newsletter in the world. Now, the newsletter, it's a unique newsletter. Everything I do is unique, I think. But basically, it's a 20-minute video briefing. It's not a written newsletter, it's a video newsletter. I don't want to waste your time. So I put out a 20-minute video briefing, and what it does, it comes out every Sunday night. And what I do is I make it super easy to trade. So I actually have a trade sheet with all the trade recommendations. It's specific, it's actionable, it tells you buy here, sell here, take profits here. It makes it easy. So the analysis is in the 20-minute video briefing. I go over all the new trades. I go over all the old trades every single week. So you're always up to date on what's going on. And of course, the trade plan that I outlined to you a few minutes ago is what I'm going to be doing in Wall Street Winners. Now, what I'm really doing is I'm telling you what's really going on. Once again, if you do what everybody else is doing, if you listen to the blah, 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 all you end up with is a loser. So you don't want that. I'm going to tell you what's really going on, and then I'm going to tell you how to profit from it. So we do a lot of very interesting, unusual trades because we're really looking at what's really going on. These are concrete, specific, actionable trade recommendation for stocks, bonds, the dollar, and Bitcoin, even Bitcoin. And we've made a lot of money this year in Bitcoin. This is totally unique indicators and analysis. You're not going to get this anywhere in the world. If you're looking for the same old blah, 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 do not subscribe to Wall Street Winners. If you're looking for unique insights, deep thinking, and actionable advice, then Wall Street Winners is the best newsletter in the world. So it's only $67 a month. You can cancel it at any time. Okay, now I put together a special report, and in it, I've got, I think it's 6 specific trades that I'm putting on right now, and you can have this report absolutely free for your new subscription. So it's the Biden boom bust, but it's specific trades based on the analysis that you've seen that we're putting on this week. In other words, I'm putting this report out to my subscribers this week over the weekend, so they'll have it available to start making money on Monday using these specific trades. Okay, to start making money, how do you subscribe? You just go to WSW2021.com. That's WSW2021 and subscribe. Let's start making some money together this weekend. Any questions? Gosh, did I do a great job explaining everything? Or did the sound not work or what? Somebody give me a question. All right, well, if there's no questions, I really appreciate your time. I hope you take this information. Of course, I'd love to see you as a subscriber, but if not, I hope you take this information and you profit from it and protect yourself next week. Oh, hang on. Is this a trading platform? No, it's a newsletter. It's a video newsletter. Oh, thank you. People are thanking me here in the question box. Why are you not recommending Bitcoin? Who says I'm not? Well, first of all, it's a bear market. So we made money on the upside, and then we got out very near the top. And so it's a bear market right now. I don't buy things that are in bear markets. That means I'm fighting the market, and that means I'm going to lose money because fighting the market is a loser's game. So that's why I'm not buying Bitcoin right now. Maybe later, but not right now. Gold price, I think, as I mentioned, I think we're going to do well in gold right now. As I said it a few minutes ago, I'm bullish on gold right now. And I'm because inflation's coming back, because real interest rates are coming back, and because we might get an Indian wedding season finally. And all three of those reasons are I'm bullish on gold. We do have gold stocks in our Wall Street Winners portfolio as well. Somebody saying great insight. I'm glad. It's a good time to buy stocks right now. Yes, I agree with that. That is absolutely right. Now I'm getting a flood of questions. All right, let me try to keep up with them. Is this a watch list that you will give us or actual trades? I said specific, actionable, buying and selling recommendations. This is not a watch list. That's BS. That's what losers do. No, we're here to make money. So I give you and by the way, I'm doing all these trades in my own account. I don't just tell you what to do. I do it myself. Could you recommend a reliable trading platform in the UAE? You know, there's a lot of good ones, but I have to say I wouldn't want to recommend one unless I had an account in it. And I haven't had an account with a UAE broker. I do use a US broker called fidelity.com, and I'm happy with their service. I also am an affiliate of a CFD and FX broker called AvaTrade, where you can trade CFDs on stocks, and I'm very happy with them as well. Let's see, is the S&P at an overbought zone? No, it's not. Should we be cautious now? No, it's not overbought right now. We've been going sideways for, gosh, almost 2 months. So we're definitely not overbought. We should be cautious, though, as I mentioned in my presentation, coming up in August. So I think we got 2 months on the long side that we could be making money. So I'm pretty happy for that. Muhammad asked the question, what is your advice for mutual funds? Usually they are kept for a few years. Should we keep them? I don't think we're in an environment where you want to buy and hold. I'll be real honest with you. I think we need to be more of a trader than an investor right now, because I think that the Biden bust could be a big one. Now, it's a year from now, but you're talking about holdings for a few years, and I find that a little difficult to want to do. Remember that I'm a professional trader, so I have to make money every year, and I have made money every year for 50 years. So I have to be nimble to make sure that I don't lose money. Very, very, very important. Do I see the US dollar going further down in June and July? I do. Not a lot, but I do. I'm generally speaking bearish. Right now I am long pound US, and I like that one the best. I also like long euro, short yen. What is the best precious metal stock? I don't buy one. I actually own several, okay? Because different stocks have different capabilities. So I like a portfolio of precious metal stocks. I think that's the best way to play it. So you want a junior miner, so there's a lot of volatility in the stock. You can make a lot of money. And then I also like having, of course, a big company that gives me a little dividend and stable and not so volatile, but will continue to go up. Do you think there'll be any major market drop till October 2021? No, I don't. I think we're in a bull market right now. The ascending triangle formation, I think, will be broken out to the upside, and we'll make some nice money on that. Should we take a bank loan and invest in stock? I can't answer that question, Mohammed, for the simple reason that I don't know your situation. That's a personal finance question, not an investment question. So I have to pass on that one. What is the best sector to buy stocks? Right now, the best sectors are the ones that are sensitive to inflation and are sensitive to the economy and to interest rates. So material stocks, industrial stocks, not growth stocks, not Facebook, not Google, none of those classy stocks that were great last year. Those are the wrong stocks this year. This year, you want to be in old industrial type stocks, okay? Biotech, not doing that well. Biotech, once again, I mean, biotech had its day in the sun, but right now, because interest rates are where they are and because inflation's coming back, those things don't help biotech. They don't help technology stocks. They help old-fashioned material, industrial, financial stocks, bank stocks. I like bank stocks right now. All of these are sensitive to interest rates and the economy. And that's going to be where, because of this boom, those are the stocks that are going to make money over the near term. Now, a year from now, things will be different. We won't want to be in any of those stocks. We're going to want to be in different stocks, which of course is why you need to subscribe to Wall Street Winners. So, all right, looks like I finally exhausted you. Please take a look at WSW2021.com and subscribe. But even if you don't, I want you to go make a lot of money. I want you to protect yourself from the bust. I want you to make money from the boom. And we'll talk to you on our next webinar. Thanks very much, everybody. Talk to you later.